Meantime, joining us right now to talk more about the markets, a big week ahead for the Fed and so much more, Allianz and Gramercy advisor Mohamed El-Erian. He's also, of course, the president of Queens College, Cambridge. Good morning to you. Mohamed, Mike was just talking about all this stimulus money that's expected to flood into the market or not, depending on your perspective. What is yours?
Good morning, Andrew. So I think some of it will come into the marketplace, and the market is positioned for that. And it's one of four factors driving this market. Over the weekend, Goldman took its growth projection up to 7% for the U.S. Others will follow. So you have a brighter future for U.S. growth. The market has handled well so far the rise in yields. That's encouraging. And then the market expects the Fed to remain ultra loose, not to respond at all to higher growth and higher inflation projections. So put all these things together, and you get the market going higher unless one of these things change. And so far, the market is confident that none will change.
But here's the thing I can't figure out, Mohamed. Wasn't it clear that this stimulus plan was going to pass? And wasn't it clear that that stimulus money was going to already end up in the market? Isn't the market supposed to be able to look at these things in advance?
What was not clear is that the market could absorb a rise in yields to 162, 164 on the 10-year without a major disruption. That was not clear. And the market has handled that well. Now, we have this very strange, and Joe referred to it, this very strange positive correlation between a high beta stock index, the NASDAQ, and the 10-year yield. They've been moving together, and they should be moving inversely. So the NASDAQ seems to be particularly sensitive, but the market as a whole seems to be able to navigate through these higher yields.
Hey, Mohamed, Goldman has a note out today suggesting that stocks would be able to handle it even if the 10-year went to 2%. You agree with that?
So they're projecting 190. I think it's a possibility, not a probability. The higher you go, the more you erode two things that have been very important for this market. One, the notion of TNET. There is no alternative. Well, you know what? Bonds are getting more attractive. And two, the model-based trading based on discounted cash flows. So I'm not as confident as they are that if we move all the way up to 2% or 190, that the market will do well. I think we will see a lot of rotation, and it will become much more a individual name picking than a market as a whole.
Talking about Bitcoin with you over these past years, but we were talking to Mike Novogratz earlier, and he was arguing that one of the reasons that Bitcoin moved as high as it did over the weekend was, again, the stimulus money going there. Doesn't it suggest that we're overheated, or am I being too skeptical, if not cynical?
So you can look at many things that suggest we overheated, whether it's celebrity SPACs, where it was happening on certain of the crypto. But remember, this notion, which is a very powerful notion, Andrew, and I'm sorry for repeating, it's a rational bubble. As long as liquidity floods the system, we will decouple from fundamentals. So it will look like it's overheating, but it is rational because so much money is coming in. It continues to come in even as prospects improve. And that is the trade-off that investors have to figure out. Do they continue just betting on liquidity, or do they worry that liquidity itself becomes an issue? And that's what the market has been dealing with. And you've seen them the market has tried to adapt different ways through rotations. Right. But that's what we're dealing with. In terms of Bitcoins itself, sorry, go ahead.
No, I was just going to go to where you're going to say on Bitcoin, and then I have a different question.
No, Bitcoins is fascinating to me because you have the positive adopters, and they believe that Bitcoin is a currency. Then you have those doing it for negative reasons. They don't trust the dollar. They don't trust bonds. They don't trust governments. And then you have another layer of speculation. And that is what's playing out. And it's been an incredibly powerful but volatile process.
We're going to be hearing from Jay Powell later this week. Do you expect him to say anything about this? And the other thing I was going to ask you, even apart from all this, is I don't know if you saw Janet Yellen over the weekend talking about taxes, including corporate taxes. Nobody seems to, it's funny. Typically, when corporate taxes become a topic of conversation, the market gets frustrated, upset. You see it. Nobody's having that issue this time.
Yeah, you know, Secretary Yellen's not the only one talking about this. They did so in the UK. But the reason why the market's not taking it seriously is the market lives in the moment, and the moment doesn't include tax increases. To the extent they come, they'll come later. It may not happen. The standard is 50-50. So the market is not taking this seriously. As to what Chair Powell needs to say, it's really tricky. We've noticed that it's very hard to navigate this environment. People want to hear all sorts of competing stuff. I suspect that the best thing is for him to say nothing, but it's very hard to say nothing when you have a press conference. So whatever he says will contribute to some market volatility, because what the market expects him to do is magic. And I doubt that he can produce magic in terms of statements.
Shepard Smith here. Thanks for watching CNBC on YouTube.